Hi there, it's Friday the 2nd of December 2016. My name's Andy Rowe and this is trendfollower.co.uk. So welcome aboard and thanks for watching this video. What I'm going to do first of all is give you a quick disclaimer because of course I'm not a financial advisor. These videos are just about what I do. Please don't take them as financial advice. If you follow what I do, of course you might lose all your money and more besides. So just regard this as entertainment if you will. Now, what I'm going to do is just talk you through my trading system very briefly and tell you about the different asset classes as I see them as of today, close of the markets Friday the 2nd of December. So what I do is to divide my investment pot into 5 different wedges. So we've got shares, we've got property, we've got gold, we've got commodities, and we've got bonds. And I'm interested in all of these, of course, which everybody really is interested in. But the way that I look at things is not just to split everything 5 ways. I use a timing system with each of the asset classes. Well, 4 of them anyway. I'll tell you about the last one at the end. But essentially, when the price of the asset class rises above the average price for the year, then I'm interested in buying, and so I invest everything into the asset class, or the fifth that's allocated to that asset class is invested, and I stay invested in the asset class all the way until the price drops below the average price for the year. Now, the average price for the year is a moving average, and there are 52 weeks of the year, and so I look at the different asset classes once a week, and so I use a 52 MA. So that's what this green line is. So when the price drops below the 52 MA, I convert the asset class back into cash, and I stay in cash until the price rises above the 52 MA, and then I invest back into the asset class again. So it's a trend following system with timing. So I'm only interested really in being in the asset class if it's going up in value. Why would I want to be in it if it's going down in value? I don't want to be invested if that's the case. So what I'm going to do first of all is look at shares, and to be exposed to shares I use a unit trust called Fundsmith Equity, which has 20 to 30 different shares, sort of US and UK based, high quality shares, blue chip stuff with big moats of value around them, very difficult to replicate. It's a very popular unit trust at the moment. It's doing really well. This is its graph at the moment, so you can see this black line is a weekly line, and the each point on the line represents the price at the close of each week, and you can see that the price is falling at the moment. So it's still above the MA52, so I'm staying invested, but I've noted it's falling, but I'm not going to get out anticipating it falling below the MA52, because it might not go below the MA52. It might rise again next week. Who knows? That's the whole point. So it's a trend following system that I have rather than a trend predicting system. So at the moment the price is closed above the MA52, so I'm staying invested in shares. Nice and easy. Okay, let's look at the next asset class, which is property, and I use the TR Property Investment Trust to gain an exposure to property, and TRY, which is the ticker symbol of TR Property, has exposure to property in the UK and on continental Europe. And the price of TRY Investment Trust has been falling. It fell quite a bit this week, it fell quite a bit the week before, it fell quite a bit the week before that. That was my signal to liquidate. I bought it in here, I sold in here. It was a losing trade. It's been very choppy recently. At the moment it's below the MA52, and the worry is of course that it will fall significantly lower, so I don't want to be invested in TRY if that happens. And that's really the whole point of this trading system, is to stay out of the market whilst prices are falling, trying to avoid the catastrophic losses in value of asset classes that happen really to all asset classes and can happen at any stage. Okay, I'm going to look at gold next, and a couple of weeks ago I had a signal to sell gold. I kind of dithered about it a little bit and didn't sell it until last week. I did sell it last week, thankfully, because it's fallen more this week, and it's well below the average price for the past 2 years. I use the MA 104, 104 MA, so 104 weeks in a 2-year period. Gold's very spiky, so using an MA52, I find I get chopped in and out of the market a little bit too much. So the 2-year MA seems to work better for me. So I had a signal to buy earlier in the year, and it was all going swimmingly well until it wasn't. And a couple of weeks ago I had a signal to sell, so I sort of dillied about a bit and didn't sell for another week or so. So the price went down still further. I sold, and this week it's gone down even more. So I'm very happy to be out of the gold market, and I'll stay out of the gold market until the price rises above the MA 104. So there we go. This part of my investment portfolio is in cash at the moment. And so now I'm going to look at commodities, and I use the City Natural Resources High Yield Trust to give me exposure to commodities. It has a mixture of mining and resource shares and securities. So CYN has done very well this year. You can see at the beginning of 2016 it was down here. It's done stonkingly well. It's gained about 30%. It's well above the MA52. The MA52 for CYN is rising, which suggests that it's on the up. Past 2 or 3 weeks it's gone down a little bit, but I'm not worried about that because it's above the average price for the year. So I'm going to stay invested until such time as the price closes below the MA52. So I'm staying exposed to commodities. Let's look at bonds. And now I don't trade bonds, I just have an exposure to bonds because they chop above and below their MA52 so much that it becomes a bit of a pain, and it becomes loss making to trade them. So I have 3 different bond ETFs that I'm exposed to. They're all done through iShares. One is one that's denominated in British pounds, one's denominated in euros, and one is denominated in US dollars. So I just hold these. So I've got a bit of currency hedging in bonds. There is some suggestion that the past 30-year bond market, which has been in a bull sort of phase, has peaked and is going to drop. So whether this is the case or not, I have absolutely no idea, of course, but I'm just going to hold them and see what happens. So I'm not going to try and trade them. The bottom line is, what do I have to do this week? Well, nothing. I'm staying exposed to shares. My property trade is now in cash. My gold trade is now in cash. My commodities trade still continues to run, and my bond trades I hold anyway. So I don't need to do anything this week. It's nice and easy. Okay, so that's the whole point really. Try and benefit from changes in the price of different asset classes, and stay away from them when they're going downhill. So that's my trading for this week. Don't have to do anything. Nice and easy. I'll do another video for you next week. Don't forget, have a look at my website, trendfollower.co.uk. Make sure you subscribed to my mailing list, and on YouTube, which you are at the moment if you're watching this, make sure you're subscribed to my channel, which is simply called Trend Follower. So you'll find it, and just subscribe and you'll get my videos as and when I do them. So hope you enjoy that, and happy investing and trading. I'm not here to give you any advice, I'm just telling you about what I do. So hope you get on just great, and I'll catch up with you next weekend. Have a good week. Bye for now.